Hello, in this lecture we're going to look at a problem that will work at the net present value calculation under two scenarios. Those scenarios being depreciation at a straight line rate versus the depreciation at a maker's rate, or kind of like a more of a double declining rate. And the difference will be then that basically there's going to be a tax difference between those two. That will be the difference in the value of the two projects. So let's take a look at that. Here's our data over here. So we got the investment for 100,000. We got the life of the equipment is 5 years. Yearly income for 6 years is 72,500. The tax rate we're going to say is 40%. All right, and then we have our data as well in terms of the straight line method and the maker's method. Notice we're talking about years here. So you got year 1, year 2, year 3, year 4, year 5, year 6. And we bought it in this year. And generally for tax purposes, most of the time we assume it's basically purchased in the middle of the year. So that's why we have 6 years, and we're not saying it's purchased in January the way it's calculated here. So it's a 5-year property. Depreciation's over 6 years because we usually have that half-year convention. So if we took, for example, just to take a look at this calculation real quick, if we had the 100,000 divided by 5 years, that would be the straight line, divided by 2 if we bought it in the middle of the year. That's where we're getting this 10,000 and then this 20. But the data is given here. Makers is going to be over here. So this is going to be similar to a double declining rate. So just to give an idea of this, it's not exactly double declining, but just to give an idea of the first couple of years, how would we calculate something like this? We'd have the cost, the 100,000, and remember that I'm just going to do this kind of the short way to get the straight line rate, which you could say 1 divided by 5, meaning it's 5 years. So if you take 1 divided by the number of years, then that'll give you the rate. So I'm going to say this equals 1 over 5 years, and that means the straight line rate is 20%. Note that that is already formatted as a percentage right there, so we formatted it as a percentage. And then if we multiply that times 2, then that's the double declining rate. So we're going to say the 20% times the 2, and that'll give us 40% double declining rate. So therefore, this first 20,000 is calculated as the 100,000 times the 0.4, 40%. It would, be the 100,000 times 0.4 would be the 40,000, and then we would take that and divide it by 2 because it's half the year again. There's the 20,000, and then in year 2, it would be 100,000 minus the 20,000 that we did in year 1. We're going to take that book value and multiply it times 0.4. And so that's where we're getting the 32. So the point is of this is the data is given here, but the difference between the methods results in a greater depreciation on the accelerated method than under the straight line method. What will that do under the two options here? We'll have to take a look at that, and the difference, of course, will be a tax effect. We usually would like to accelerate the depreciation for taxes most of the time. All right, so we're going to go down here and take a look at our straight line versus the makers. We've got years 1 through 5. We're going to start off with the income before depreciation. So that's going to be the 72.5 that's given to us in the data. So that's the income before we're considering our factor that's going to change. And that will be the same all the way down. So I'm going to say equals that number and bring that all the way down. We're going to say we have an even income over this 6-year period. And then we're going to have the straight line depreciation, which is up here in our data. So the straight line depreciation is going to be 10,000 for year 1. It's going to be, it's going to be 10,000, but not that 10,000. It's going to be equal to this 10,000 in year 1. It's going to be equal to the straight line 20,000 in year 2, 20,000 in year 3, 20,000 in year 4. Bit repetitive because it's straight line. And year 6, we have that half year again. That's why we have 6 years, even though it's 5-year property. Then we got the taxable income. So if we were to calculate the taxable income, it would be the equal to the 72.5 before the depreciation minus the 10,000 in this case. In year 2, the 72.5 minus the 20,000. And yes, we could copy that down and it should subtract those out. So I'm going to just put my cursor here, autofill. Auto drives it down. Dr. Phil does the calculation. And there we have that all the way. And then we've got the income tax. So remember, the tax is 40%. We're assuming a 40% tax rate. So if that is taxable income, then we're going to take this 62.5 times 0.4 for 40%. And we're going to do that all the way down. 52.5 times 0.4. We're going to say this equals to 52.5 times 0.4. And we can then copy that down. So that's going to be the income tax. If we were to calculate the net income, then net income is going to be the 62.5 minus the income tax, 25,000. And we'll take a look. The next one's going to be the 52.5 minus the 21,000 equals the 52.5 minus the 21,000, and so on and so forth. And we'll autofill that down. So put our cursor right there and autofill that down. Then we've got the net cash flows, and note that there's a difference here, of course. We're not necessarily looking for the net income. We may be looking for the net cash flow when we're trying to compare two projects. So we'll calculate the net income here, but we're probably more concerned even with the net cash flow. So the net cash flow then is going to be equal to the income before the depreciation minus the taxes, the income taxes that we're going to have to pay. So notice what we're basically doing here. We're not including the non-cash item. The only reason we're dealing with the non-cash item is because it results in a cash item, because it reduces the taxes that we're accounting for here. So here's going to be our cash flow of 47.5. So we're going to say the 72.5 minus the tax for taxes. And obviously we can do that all the way down, 72.5 minus the taxes, and so on and so forth. So we'll autofill that all the way down. Okay, so we're going to compare that to the makers. Same type of method, but we're going to be in the makers depreciation now. So it's going to be the same starting point, same income, 72.5 all the way down. I just double clicked on that to fill that all the way down. Then we have the things that will differ between the two areas. Here we have the accelerated method of makers. So I'm going to say equals, and that's going to be coming from this row where we have 20,000 rather than the 10,000 before. And for year 2, we got the 32,000. For year 3, we got 19,200, and so on. So I'm going to copy that, going to auto-fill it down, auto drives it down, Dr. Phil calculates. So we just pulled those numbers on down. Then we're going to have the taxable income then will be the income before the tax minus the depreciation. So we're going to bring that all the way down, income before the tax minus the depreciation, and we'll bring that down. I'm just going to double click this time, double click, bring that all the way down. And then we have the income tax at the 40% rate. If this is our taxable income equals the 52.5, then we multiply that times 0.4, 40%. And we're going to do that all the way down. We're going to say the 40,005 times 0.4. And once again, I can just autofill that down even though there is a hard-coded number in it. So we can just see that hard-coded number of 0.4 in there. And it is doing what we expect it to do. Then we're going to say net income. Net income will then be the income before, which is the taxable income, minus the income tax. And we get the 31.5. Again, we could do that all the way down. But what we're usually, and I'm going to autofill, double click, autofill. But we're usually looking for the cash flow. So we're going to be over here in the cash flow now. And remember, what we're doing is we're going to say the cash flow is the 72.5 minus the taxes. And note what we did there again is we pulled out the depreciation. We don't want that in our calculation because it's not tax related. But we had to figure net income with depreciation because of the cash flow effect of taxes and the effect of depreciation on them. So we're going to take that all the way down. We're going to say the 72.5 minus the tax here, the tax, and do that one more time. 72.5 minus the tax, and so on and so forth. I'm going to copy that all the way down. So there we have that. Then, now we're going to do the present value. Now, you could be saying, well, why don't we just sum this up? I mean, if we added this up, it's here, the 301,000, and we add this up, we're at the 301,000. Note that they're going to be the same there, and we might even want to put a row in there. I'm going to actually do that. Insert a row and have total, and we'll sum these up. So there's our cash flows, 301, and the total. And we'll sum these up. And there's our cash flows. I'm going to go ahead and format this. I'm going to highlight this. I'm going to go to the Home tab, format that. I'm going to format this. We're going to highlight that, Home tab, format that. And we may want to double underline these two. I'm holding down Control. I'm going to select both of those, and we can double underline. Now, you might be saying, well, you know, it's the same cash flow under both items. And, well, of course it is, because it's only a timing difference. But there is a difference, and that difference will be the fact that there's a present value of money. So the depreciation is a timing difference. Why does it matter whether we do the straight line method or the double declining? Because the money's worth more sooner. We would rather have it sooner. So if we account for that, how can we measure that? How can we account for that? We can use the net present value calculation. So we're going to do the same type of idea here. We're going to have years 1, 2, 3, 4, 5, and 6. And we've got the net cash that we're going to pull down here. So we're going to say the net cash for the straight line method was the 47.5, and I can copy that all the way down. So we got the net cash here, net cash all the way down, and I'm just going to copy that down at this point. Copy that down to here. And then we're going to have to look up the present value factor. Now, there's a couple ways we can do this. One, we could use formulas, but we can also use looking this up in a table, and that's often the easiest way to do this. Figure out a table to look up. What do we need in order to look up the table? We need the percentage, the discount rate in this case, and how are we going to get that 10% discount rate? A couple factors involved in that. One is, the main factor is, what else could we be doing with the money? That's basically what we're going to set the discount rate at. What return could we get from some other investment? This investment, therefore, needing to be greater than that. We also know that there's just the time value of money in terms of interest. So, you know, money will deteriorate in value at least 1 to 3%. So we definitely want to get a return of that on it. So that's the ways that we would have to come up with a discount rate in some way in order to figure this out. When we look up the table, we're going to have to look up, notice that the data is not the same for each year. So we cannot look at an annuity, which would be nice and simple, where we could just see an annuity statement. What we have to do is actually present value each of these at its own, on its own. So if we're going to assume that we got this 47.5 at the end of the year, a year later, then it's not just going to get 47,500. We're going to get something slightly less when we talk about present value dollars when we discount the money at 10%. Same if we get it for 2 years out and 3 years out and so forth and so on. So we're going to look at these tables. Now, there's usually a bunch of different types of tables. You want to be kind of clear on, you want to be real clear on what the tables are. So we got if you see a present value rule of an annuity, that means that you're bringing, an annuity has all the same payments, and you're bringing that back to the present current value. And you'll note that the table here, if we looked at the 10% area, they're all greater than 1 once you get past the year. And the reason for that is that, of course, we're talking about multiple years. So it's going to be greater than 1. And we also have the future value. If in this case we have the future value of 1, that would be us trying to compare today's money to what the money would be worth in the future at this discount rate. We don't want to do that. We want to bring the future stuff down to today's day. So we're going to go to the present value of 1. And the reason we have to do it of 1 and not the annuity, remember, is that we don't have an even flow of payments. So if we were to go to the 10% column, we have to take this one, multiply the year 1 for 1 year later times this, and we got to multiply a year 2 for 2 years later times that, and for 3 years later times that, for 4 years later times this, for 5 years, and 6 years. So that's where I'm going to pull this data over here. So I'm going to go back over here, and we'll plug those numbers in. So present value for year 1 is 0.0909. I'm not sure I got that. 0.9091. And notice I added all 4 decimals so we can see all 4 decimals. If we were to multiply that out, then we're going to say that the 47.5 is the cash flow, but it's only worth 0.9 of that, or 43,182. So if we took the next one, we're going to say this is going to be 0.8264 tab. I'm going to say this equals the 51.5 times the 8264, and it's worth even less because it's 2 years out. Year 3, we're going to multiply it times 0.7513. So we're going to multiply that out. This equals the 51.5 times that. It's even less because it's 3 years out. And year 4 is going to be 0.6830. And we're going to say this equals the 51.5 times that. And it's, of course, going down. We could see a trend here. We got this 0.6209. And we'll multiply that out. Now, Excel did that for us this time. And then if we take the last one, it's going to be 0.5645. And if we multiply that out, it's even less here. So that gives us the present value of the cash inflow. Present value of the cash inflow. And we'll sum that up. So I'm going to sum that up. Equals the sum of these items here. And we'll enter that. So notice that cash flow is different than what we got up here, of course, because now we have present valued it. Now we're going to have the present value of the out, and that's going to be nice and easy to calculate it because the outflow all went up at the beginning of the project. It is what it is. It was 100,000 at the beginning, and that doesn't change. So we're going to say 100,000. We don't have to really do anything to it. We don't need any tables for that because 100,000 on the day we started is 100,000. If we had some more complex kind of structure in terms of payments as well as the income, then we would have to get more complex and use the tables to present value those as well. So that means that the net present value will be equal to the 218,398 minus the 100,000. So 118,398 under the straight line. Let's look at the maker's depreciation here. Same type of idea. We're going to say year 1, year 2, year 3, year 4, year 5, year 6. And we've got the net cash flows. So we're just going to pull that down from the data we have over here. Net cash flows is the 51.5 for year 1. It's going to be the 56.3 for year 2. It's going to be the 51.180 year 3. And year 4, 48.108, and so on and so forth. We're going to use the present value factors. Now they're going to be the same because we're using, it's still a year out. What's going to be different, of course, is the cash flows. Notice we got more money earlier here, even though the total flow is the same. That's the point that we want to get. So I'm going to just pull these over. I'm going to say this equals the 909.1. This equals the 0.8264 and so on. We're going to pull this all the way down. And there we have that. And then we're just going to multiply this out. Now, we've got the 51.5 rather than the 47.5 times the 0.9091 gives us the larger present value of the 46. But we're going to say the 56.3 times the 0.862 gives us a bit more there. We're going to say we have the 51.1 times the 0.7513. Then we have the 48.108 times the 0.6830. Notice now we're getting to the point where it's less in the back end here. And then we're going to say this equals the 84.108. Let's multiply that. This times this. And we'll do the last one. I'm just going to copy it down on the last one. So if we total this up, then I'm going to say net present cash flow. I'm just going to say that's the same number here. And we sum this up. Summing that up, we then have the 220,381. And notice we have more cash flow here than we had here under the net present value at the discount of 10%, even though we had the same cash flows if we just looked at dollars in general. And that's going to be the effect of the present value. So then we're going to have the same present value of the outflow because that happened at the beginning of the year. That's the original investment. That's the 100,000. And that gives us the net present value. Net present value is going to be the same here as there. And that's going to be equal to the 220,381 minus the 100,000 gives us the 120,381. So therefore, that's why we generally would want to accelerate the depreciation. Although it's just a timing difference, we usually want to get that difference earlier. We would rather have money today rather than tomorrow. Why? Because of the time value of money.